When it comes to investing, emotions can be our worst enemy. Feelings of fear and greed can override rational thought and lead to poor choices. Make enough of those and it can have a significant impact on your real life return. As we head into the second half of the year, it's time to hit the pause button on the noise and reflect on what really matters when it comes to stocks. That's all coming up next. Hello, welcome back to our show, Wealth Wednesday. If you'd like to check out previous episodes, visit our YouTube channel. That's at Commonwealth Financial, or you can check us out on the web. That is cfswv.com. Fear and greed are two very powerful emotions, and both of those can lead to some poor choices, especially when it comes to money. Today, my friend Vince McManus, an advisor in our Parkersburg office, joins me to talk about this. Vince, this is something where our opinions are very similar, and it seems like a great time to dig into this. The news media has us laser focused on November, and that has people on both sides squirming quite a bit. From the investment side of things, does it matter?
No, it does not. That's the simple answer that I try to get through to people and I talk about. Again, unless you're in a situation where every single bit of your money, it needs to be spent around November or the end of the year, it's not something that we typically care about for our long-term money. The stock market has performed well over Democrat administrations, over Republican administrations, through World War II, through Vietnam, through 9/11, on and on and on of things that happen. When you zoom out and you look at these events, they are fairly insignificant in terms of what the market does over a long time period, which makes sense when you think about what the stock market actually is. It's just a collection of businesses. And what do businesses do? Businesses are in a capitalistic system. Their goal is to make money. So while they have to deal with the government or the regulations or the rules that are put in place for them, they have to navigate around those, but their goal remains the same. And when you have capital that is supposed to be allocated efficiently, it's like water. It's going to find where it needs to go. It just may take a little bit longer depending on the climate that we're in. But through all climates, over the long term, we expect businesses to make money and therefore the stock market to trend and upward into the right.
Yeah, that's a great point. And I saw a great quote from Winston Churchill here recently. The farther back you look, the farther forward you see. And the value of perspective is so important when we're talking about investing and money in general. There have been so many things, as you mentioned, that we've experienced through time, and these businesses survive and thrive. We place way too much emphasis on headlines and current news stories that have a shelf life of minutes and not enough on the things that are really valuable. Clients are asking me when we do our risk survey, where do you score on? And I'm usually pointing way off to the right because it is far beyond what they would even expect. They say you're young, but really I'm not that young anymore. I just put more value in the perspective and the longer term evidence that we see, and that stocks over long periods of time have a tendency to do better than most every other asset class. Vince, more recently, we've seen the return of FOMO, or fear of missing out. There's NVIDIA and other tech names that are leading the AI revolution. There's big headlines about many of those companies, and they've been driving returns of the market. And now there's a new product in the investment world that's been released that tracks the 7 biggest companies in the NASDAQ, and then it tries to leverage that. Why could this be a really bad idea?
Well, a big reason that's a bad idea is, again, using things to leverage returns means you're trying to do something quicker, which may work out for you over a shorter time period, but long time period, again, even stocks, they tend to be volatile, and they tend to go down from time to time. But when you leverage on the upside, you're also leveraging on the downside, and that's what causes people to blow themselves up sometime. Again, it gets into the greed aspect of it. But I would also say with those companies, just based off of historical evidence, is a lot of the gains in those have to be behind us. Okay, now over a long term, markets have to behave somewhat rationally, and there has to be some level of earnings multiples that we consider as a quote unquote good purchase for a business. And even at insane amount of growth, some of these businesses are probably at worst healthily priced right now, which is okay. It doesn't make them a bad business, but it can have a huge effect on the value of their stock over the next decade or so. An example that I use quite frequently is McDonald's. Okay, so back in the late 60s, which was considered like the go-go years, and there was some stock strategies noted as the Nifty 50, and it was the idea you just buy these 50 stocks and they're going to go up forever, blah, blah, blah. Again, the same thing, just a little bit different. That's a theme that tends to happen. But McDonald's wasn't at that time what it is now. It was a growth company. And during the 1970s, they were massively growing, okay, like 40% per year. However, their stock price basically stayed stable for an entire decade. Okay, obviously we know McDonald's. At that time, McDonald's was a good company, right? NVIDIA may be a great company, but the idea that it's going to continue to kick off this kind of growth forever and ever and ever is just not rational. So what we usually suggest, again, if you need to scratch that itch and you need to kind of play that gambling type thing, that's fine, but you also have to have a larger bucket of your money that's quote unquote more boring. Okay, and that's really betting overall on the entirety of the market. The concept of diversification, which I talk about frequently, and the idea is, hey, if I'm properly diversified, I am giving up the best possible return. That's a fact. I'm also giving up the worst possible return. And when we deal with all this stuff through the lens of a planning perspective, that's something that's very powerful and allows people like myself and Neil to be much more confident of what do the next 10, 15, 20 years look like when we're not taking these really, really targeted bets and trying to make a quick buck. Again, discipline is key in life, and it's no different in investing.
I want everyone to keep something in the back of your mind as we're heading into the second half of this year, and we're going to have a lot of news headlines and all this. So remember this, we've seen exactly 0 interest rate cuts so far this year. And at the beginning of the year, they were forecasting 4, 5, even 6 in some places. And that just hasn't happened yet because the inflation news hasn't been as good as people were hoping. Earnings are forecast to be almost 9% higher this year than they were in 2023 and nearly 14% higher in 2025. Dividends have gone up. Those two things, earnings and dividends, that's what truly drives the value of the companies that we own. The news talks about everything else but this. We're going to hear a lot of things over the next several months as we get into the political stuff, as well as everything that's happening overseas, inflation news and all those types of things. But it's the earnings and the dividends that continue to drive the long-term results of the stock market. Vince, fear and greed are tough emotions to control, but it's critical that you keep those in check. What are some final thoughts you can share with our viewers today?
The same thing I say in meetings all the time: turn off the television. Especially in an election year, and especially in this one. I've been known to, I've become aware to me that there was a debate the other night that was apparently very entertaining and not in a good way. I've convinced myself that I will never watch things like that, and I'm staying true to it. But I get a lot of questions about it, and I see it everywhere, and it's just something that when you're tuning into the television constantly, it's fine, but you just have to keep it in the proper perspective. That has nothing to do with your long-term investment plan. Okay, it doesn't matter to me like what someone says last Tuesday or next Thursday. It's just par for the course. It doesn't affect the long-term trajectory of what companies are actually trying to do and how they implement their business plan, which should lead to an increase in the stock price. Again, I always say this: CEOs are paid millions of dollars for these large Fortune 500 companies to do what? To increase the stock price. Okay, so that is always going to be their goal, and that's what they are going to do over long time periods, or their business is going to die, but some other business will step in. And that is the concept of creative destruction, and that is the fundamental basis of capitalism. And no matter who is president next, again, depending who I'm talking to, I don't think that's fundamentally going to change.
Great stuff. Hey, if you'd like to catch up on past episodes, you can do so again. That's at our YouTube channel at Commonwealth Financial. Visit us on the web at cfswv.com. If you're concerned about your investments, you can reach out to a guy like Vince or myself, and we can talk you through everything that we've covered today. Thanks for watching, everyone. Have a great week.